Hey, it's Bear here, and we're going to do a supplemental instructional video on charts, how to do the charts for the final exam, and we're going to review fees and costs very briefly. All right, some things about the upcoming schedule. Monday, April 26th, CPA number 10 is due. That's reading that short book and doing a short essay about it, posting that to Blackboard. On Monday, April 27th from 9:10 to 10:05, we'll do a Zoom session, a very interesting class covering a topic called ethics and justice. So I hope that you can attend to that. I will record it and post it online. Uh, Hopefully we'll have some volunteers that will help participate in that class because the class only works with some class participation. On Friday, May 1st, CPA 6B is due. There will not be a video for that assignment. It is will be posted on Blackboard. I believe it is already, and basically it's a little bit of readings and answering some short essay, I believe. I will do a separate final exam review video sometime in the next week or two, and we'll post that for you before exam week, before we do the final exam review sessions, certainly. Uh, Final exam review sessions, I'll schedule two of them. One will be in the morning, Monday, May 4th, 9 to 10 o'clock, 9:10 a.m. Central Daylight Time. And the other one will be that evening, Monday, May 4th at 7 o'clock p.m. And that's those review sessions, which will be done via Zoom, will be structured more for question and answer. So come with questions that you might have. Anything, any topic, any question that you have is fair game, except please don't ask me, oh, what are the answers for the exam? All right. So about the final exam, you can take it either one of 2 days and times, Monday, May 11th or Friday, May 15th at the time shown. And if you're unable to attend any of those times, or you just have like 3 exams on the same day or something, you can't fit that out, let me know by email and I will get back to you and we'll discuss it. Now, the exam is going to be online, but only in the sense that I'm going to provide you at the start of the exam period a Word document that you will download. You'll complete 2 charts, and it involves a long hypothetical set of facts, probably about half a page, even a page long. And you're going to be not only doing the charts on establishing an appropriate strategic asset allocation, rebalancing, determining the expected, but you'll also be doing a tax efficient asset allocation among different types of accounts. And then there'll be a long essay, one long essay on the set of facts that basically you'll be exploring how to build a portfolio either for a young couple, a married middle-aged couple, or a couple that is near or in retirement. Just make a note, obviously I'm going to make the exam on Monday different from the exam on Friday in terms of its content. Uh, the exam will be done by a Word document again. You can type your answers, you can handwrite your answers, and then scan them and upload your answers as a PDF file. Either way does not matter to me. The 2-hour time limit will be strictly enforced, however. So let's go to this video. What are we going to cover? Well, first we're going to say you ought to be suggesting a strategic asset allocation, and then determining rebalancing thresholds and determining the expected returns of that portfolio. So we'll do a chart on that, and then do another practice chart on that. Determine the most efficient asset placement into different types of accounts. We'll review the rules for that, do a chart, and then do another chart on that. And then we'll review the fees, costs of mutual funds and exchange traded funds, really by looking at a summary prospectus. So here's the first type of chart that we'll see. All right. And at the top, we see that we have different asset classes here on the left. Then we have the expected return of that asset class over the next 15 years. On average, each year, what do we expect that asset class to return? In the case of U.S. large cap balance stocks, you can see that have a really low expected return there, and that's because large cap growth stocks in particular are very overvalued still. I'm not the only one, by the way, who thinks that large cap balance stocks will have a low return. Rob Arnett of Research Affiliates. They do a lot of great research on terms of expected returns and valuations over the next 10 years. He thinks about the same. Uh, and uh, Then we have mid and small cap value stocks with profitability and investment factors. Then we have an international developed markets value, foreign emerging markets value, and fixed income investments. All right. So we have the expected returns 4%, 11%, 10%, 12%, 2%. Now, when I talk about expected returns, that's the average annualized return. Obviously, there are going to be some years like this year where the stock market's going to be down, and there's going to be other years where the stock market's way up. What we're actually looking at is what is the average annualized return, taking into effect the compounding nature of returns. Then we come over here and we look at strategic asset allocation. This is what you would determine. You would input what you think an asset allocation is for either someone really young in their 20s, or a middle-aged investor, or an older investor. And typically you would think that the big decision there is how much fixed income investments. All right. So, for example, a person that has just entered into retirement might be 40% fixed income. Someone who's 20 years old might be 20% or even less fixed income. Someone who's middle aged might be 30% fixed income. So that's really the first decision point that you make there. And then you allocate between U.S. stocks and international stocks. So how much international stocks? About 30 to 50% of the total of all stocks. All right. And then the rest is done in U.S. stocks. Then we determine a lower threshold for rebalancing. We modify. This is not the ER. We actually multiply strategic asset allocation times 0.08 and strategic asset allocation times 0.02, and then the contribution to portfolio's returns is expected return times the strategic asset allocation as a decimal. So let's illustrate this. All right. First thing, we're going to assume we have a young investor here. So we're going to put 20% in fixed income. And then I'm going to say, okay, I got 80% left. I want somewhere between 30 to 50% of my remaining equity allocation to be in foreign stocks. So you'll say 40% of 80% is 32%. That's about 30%. So I'm going to put some in emerging markets. I'm going to put some in foreign developed markets. All right. Now I've used up 50%. I've got another 50% left here, and I'm going to really tilt towards small cap value stocks. I'm a young investor, and I'm going to go ahead and take the extra risk there because I believe there's a lot higher return there. I'm still going to have a little bit of large cap balance stocks there, just in case. All right. Then I need to determine lower threshold for rebalancing. Again, this is strategic asset allocation times 0.08. So it's 10 times 0.8, that's 8%, and 40 times 0.8 is 32. Really what we're doing is when you multiply something times 0.8, you're just going 20% less than, in this case, the strategic asset allocation. And the strategic asset allocation is times 1.2, we're just adding 20%. So again, we do that all the way down, and we do it for the next one. We show 10% times 1.2 is 212. Again, it's strategic asset allocation, not ER here. That was a mistake on my part. And we come up with these numbers. Now, you may have noticed that fixed income is 20% plus times 0.08 or times 1.2 for these thresholds. The other way of doing fixed income, and it's really helpful when you get up to having like fixed income be 40% of your portfolio, is to go plus or minus 5. So I will accept this answer on exam if somebody put 20 minus 5, 15% here, and 20 plus 5, 25% here. I would accept that as an answer as well. And in fact, I think that's the preferred answer. That's actually the approach that I use and Larry Swedroe uses as well. And now we want to do the contribution to the portfolio's returns. So we had to have one of these as a decimal It might be easier to just do the strategic asset allocation as a decimal, convert 10% to 0.10, then just multiply 4 times 0.10 equals 0.4. 11 times 0.4, 40% is 0.4, 4.4. 10 times 0.10, 1. 12 times 0.2 is 2.4. 2 times 0.2 is 0.40. And we get an expected gross return of the portfolio of 8.6%. All right. I will not on the exam have y'all the other little calculations there. They are pretty simple calculations, just adding, subtracting. Don't think it adds anything to what you're learning. At this point, at least, okay? It just takes up more time on the exam. So we're going to keep it short. Now, the charts on the exam are going to be exactly like this, except I'm going to fix this and call this SAA here and SAA here. So you will have the guide up here at the top, all right? But you got to fill in all of these categories here. So, and then add this up correctly, all right? So, here's another example, all right? I changed the expected returns. I've changed the asset classes slightly, all right, in terms of describing them, all right. And here's the expected return: 5, 12, 11, 13%, and 4%. So pause the video at this point and complete this chart on your own before I go over the answers with you. Pause now. Count down until I restart the video. 10, 9, 8, 7, 6, 5, 5, 5. Just joking. 3, 2, 1. Okay, I'm restarting. We're going to go over the answers. All right. First, I want to note that you can actually invest in these asset classes. There are funds and exchange traded funds out there. There are a lot of different large cap balance funds. One of the best is the Vanguard 500 Index Fund. It's got very low fees and costs. Does a really good job of basically giving you exposure to the large cap balanced market. The investor shares you would probably start out in, but if you have it at least 50,000, I believe it is a threshold with Vanguard, then you're able to get the Admiral shares, which have a lower fee. They also have an exchange traded funds which has lower fees, so you could go for that. I'm a big fan of dimensional funds advisors, but to get access to dimensional funds advisors, you have to have an investment advisor. If you are doing this strictly on your own, then you could also access something that's very close to dimensional funds advisors. It's Avantis. It's basically some mutual funds that were started by mutual funds and exchange traded funds that were managed by two people who left Dimensional, including the chief investment officer. They manage very similarly. And we don't have a lot of long-term data on them, but from the standpoint of their fees and their cost, at this point, I think they're really good options for individual investors when you don't have access to dimensional funds. And you can actually find these, and this is a small cap value stocks fund in the U.S. that also uses the profitability factors. International developed market small cap value stocks fund with the profitability factor used again, and foreign emerging markets value stocks with the profitability factor, all shown in these ETFs. For fixed income investments, I typically would not predict 4% because right now bond yields are below 2%. And however, if you were to use something called the SWAN ETF, which is 90% U.S. Treasury securities, got a fairly long duration, about over 8 years. 10% of that fund every year is used to buy call options on the S&P 500 index. So it does have some volatility associated with it in terms of the fact that it might go up and down in value, but it's not going to go down a huge amount, probably no more than 20%, I would say, as a downside. Upside in any 1 year could be maybe as high as 40%, something like that. I've done some modeling on this over time. It's really, it could be used as a replacement for fixed income investments. It could be used as a way of basically a separate asset class because it has some unique characteristics to it. But for a young investor, a swine ETF might be considered that. And I'm projecting a 4% return. I'm kind of being conservative here. I think the actual return could be higher. A lot of it depends on where interest rates go over time, um, and how much volatility we have in the stock market. So, if we were to complete this chart, all right, this is the way I complete it. Now, there's no one correct answer on determining asset allocation. I'm going to assume a younger investor, so I put 20% here for fixed income investments. I put 0 in large cap balance. It's got a pretty low expected return there. It's overvalued currently. And then remember, I want to put 30 to 50% in international. For myself, I'm putting a lot in emerging markets at this point, 10% in developed small cap value stocks, and 40%. So I've got half of my asset allocation here in international. That's 40%. 40% of the equities in small cap values, 40% of the equities in international. 40% US, 40% international. That's okay. It's between 30 and 50% total here for all the international or foreign allocation. All right. And then I do my strategic asset allocation again times 0.08, and I come up with 32, 48, 8, 12, 24, 36. And this could either be, again, 16 and 24, or you can subtract and do 15 and then add 5 and do 25%. If you multiply the expected returns times the strategic asset allocation, add all that up, if I did my math right, it came to 10.6%. Again, there's no one completely right answer to this, but you are going to do this on an exam where you come up with the strategic asset allocation. And what I'm looking for is a strategic asset allocation that makes sense. Now, this one uses small cap value, and emerging markets value stocks. This looks like the Larry portfolio. Yeah, it's basically it. Basically, we said we're going to use these factors and supercharge our returns. At the same time, maybe I don't need to be as much fixing as much equities as I could. Maybe I could be a little bit more conservative here. Someone who's extremely aggressive as a investor might be 100% equities, as an example. All right. So let's go on to the other type of chart that you'll see on the exam. Yep. We have the expected return. We have the portfolio turnover rate. The lower the portfolio turnover rate, the more likely it is for that fund to be tax efficient, or exchange traded fund. Now, exchange traded funds tend to be more tax efficient. The stock funds, there's a long explanation of that. And there are some mutual funds out there that are actually specifically designed to be tax efficient. But generally speaking, the lower the turnover rate, but one is you're going to have lower internal fees and costs, and the other is that you're going to have a more tax efficient, because they're not buying and selling stocks within the funds and incurring a lot of capital gains within the fund that then have to be passed out to shareholders every year. All right. These turnover rates are a little on the high side. If I was buying a fund, I would want to find something that has a lower turnover rate, try to keep that under 20%. Here's the strategic asset allocation. All right. I will likely give this strategic asset allocation or something different to you. All right. So, and then we've got 3 different types of accounts. All right. We've got a taxable account with 100,000, a tax-free account, a Roth IRA, and a tax-deferred account with 350,000 in it. So tax-deferred means it's growing tax-free, but when you take the money out, you pay taxes on it. Tax-free, a Roth IRA or a Roth 401k, that money grows tax-free. When you take the money out in retirement, you don't owe any tax on it. And the taxable account means whenever there's interest or dividends or capital gains, you're going to pay tax every year on any distributions out of that fund for that are made because of buying and selling securities within the fund, because stocks pay dividends, or if it's a bond fund, you've got interest to deal with. All right. So the amount, this totals up to 500,000. So the amount in each asset class is set forth here. I will give you this. I will give you that. Everything you see on this chart, I will give you. So you just have to fill in these 3 things. All right. Now, the steps, let's just review those. Foreign equities, foreign stocks go in a taxable account. And the reason for that is, as a U.S. stockholder, U.S. fund, U.S. based mutual fund, owning stocks in other countries, those other countries impose taxes, a lot of times on dividends and capital gains. Those taxes are paid by the mutual fund. You get a share of the credit for paying those taxes. A credit is a dollar for dollar reduction in your tax liability because you pay taxes overseas. If we have a tax treaty with that country, and we have tax treaty with a lot of countries, then you get a tax credit for those. But in order to get that tax credit, those foreign stocks, foreign equity or foreign stock mutual fund must be held in a taxable account. You can't get it if it's in a tax deferred account or a Roth tax free account because you're already getting a tax benefit there. So the first step is we want to put foreign equities in a taxable account. Then we want to put fixed income investments in tax deferred accounts like a bond fund. Why? They're generating a lot of taxable interest all the time. We don't want to pay tax on it until much later. So we want to hold that in the tax deferred account. The remaining asset classes with the highest returns after these steps 1 and 2 go into the Roth account, the tax-free growth. We want to supercharge the Roth account because we're getting tax-free growth. And then we want to take a low turnover equity asset class. Generally speaking, whatever fund's got the lowest turnover, we want to put that in the taxable account. Now, a lot of the times, what we'll see is we don't get to this fourth step. And the reason is we've already filled up the taxable account with foreign investments, for example. The fifth step is just simply filling up all the rest. So here's a way of looking at this chart. We'll go and start filling up. The number one step is foreign stocks into the taxable account. We have 100,000 we can use. We have 50,000 in developed markets and 100,000 in emerging markets. Now you could say I'll put 50-50 here. That's fine. It might be a little bit better from the standpoint of future rebalancing and not incurring capital gains to kind of split that a little bit. So what I did was split it, put 30,000 here, 70,000 here, and I'll come back to that and explain it in a minute. Next step, where did the fixed income investments go? There's 100,000 of fixed income investments, and we're going to put all of those in the tax deferred account. Third step, we want to take our remaining asset classes, the asset classes with the remaining, with the highest expected return, and put those into the Roth account. The highest expected return is actually foreign emerging markets value. Well, we got 30,000 left here. 100,000 minus 70,000, we could put 30,000 here. And then we go to the next asset class that's got the highest return. 12% expected return there. So we can put 20,000 in here. That adds up to the 50,000. Then we look at where do we put the most tax efficient asset class? That's large caps balance stocks because they have a very low portfolio turnover rate. But we got a problem. We've already used up the taxable account. So we've already got 100,000 there. So basically you don't need to do step 4. All you need to do is basically fill up the rest. And to double check, you add these up and make sure they add up to what's at the total. 100, 120, 300 plus 50, $350,000. So our math is correct. So here's another version for you. Okay, totals up to $1 million. Here's the amount in each asset class. Expected return portfolio turnover rates are the same. I did vary the strategic asset allocation. Work on this. Pause this video to do this chart on your own, and I'll do a countdown. Countdown. 10, 9, 8, 7, 6, 5, 4, 3, 2, 1. Okay, here we go. What did you come up with? Oh my gosh, where is it? There it is. Again, here are the steps. Follow the steps. Here's a potential answer. You could put 30,000 in the small cap value here, international small cap value. Emerging market 70,000. You have 100,000 in that taxable account. Now again, you could do this different. You could put 50-50 here. You could put all developed markets over here, 100,000. That's okay. All right. Sometimes in these charts, there's no one right correct answer here. All right. And then the second step would be fixed income investments. 200,000 goes into the tax deferred account. Third step, where's our highest returning asset classes? We've got to fill up the Roth IRA account. Highest is the foreign emerging markets, 130,000. And then U.S. small cap value, 12%. We can only use 70,000 of that because we only got $200,000 in that account. Right. And then the fourth step is the most tax efficient fund, the one with the lowest portfolio turnover rate. Go put it in the taxable account. Can't do that. We've already filled it up. So just fill up the rest. So very similar. All right. I told you I'd come back to why split this. Well, let's say you're putting money in emerging markets, $200,000, and your asset allocation is 20%. And emerging markets takes off, okay? And all of a sudden, you've got to sell emerging markets. Well, if you sell something in a taxable account, all right, essentially at that point, you're going to incur some type of capital gain. If you haven't held the fund for at least a year and a day, you're going to have a short-term capital gain, which is taxed as ordinary income. If it's been held for at least a year and a day, you're going to have long-term capital gain when you sell part of that fund to rebalance. But if you split it here between this and this, between this and any other account, here and here or that the other one, then what we end up with is when we rebalance, I can sell part of this to get back to my threshold. I could sell part of this to get back to my threshold. So it basically allows a tax efficient rebalancing to occur, at least for a year or two or three, maybe a little bit longer. Okay. So let me explore the fees and costs of mutual funds. All right. There's a commission that some mutual funds have associated with it. This used to be the way that most mutual funds were sold. The maximum is 5.75%. There's a rule out there that limits commissions on mutual funds to 5.75%. If you buy more than $25,000 of a fund or within a fund family, then you get what are called breakpoint discounts. The amount that you pay as a commission goes down. But I would submit this. There are brokers who still sell Class A mutual fund shares that have this commission, but the impact of that can be really great. If you hold a fund for 10 years, you're looking at 40 basis points or maybe even higher impact, depending on what assumptions you make, per year, 40 basis points per year, even. And most people don't hold funds for 10 years. So never a reason really to pay sales loads. All right. Then we have the annual expense ratio of the fund. There's a management fee that's basically paid to the investment advisor of the fund. It's also how the fund company makes profits, essentially. There are other expenses, administrative fees. This is the cost of registering, legal fees, accounting fees, registering with the SEC, printing and mailing prospectuses and things like that. And then there's this 12B1 fee. It's been around for about 40 years now. It was basically adopted by the SEC to encourage mutual funds to be sold. Basically, brokers get most of this 12B1 fee when they sell a fund. This could be 1% a year for something called a Class C share. Class A shares, remember that commission? They also typically have a 12B1 fee. It's a maximum of 0.25%. Another tip, never buy a fund with a 12B1 fee. These fees don't provide any real benefit to you as an investor. No reason to pay that fee. There's a lot of hidden costs, fees and costs of stock mutual funds and ETFs. In a stock mutual fund, you have to buy and sell stocks every now and then. So there are brokerage commissions paid. And although you hear all the advertisements, free trades, and mutual funds can limit the amount of brokerage commissions by choosing brokers that they sell with, buy and sell with, and the like. There will likely be some brokerage commissions for some of the trades that they do. There's also the bid-ask spread, the difference between if a mutual fund is selling shares of stock, right, and then somebody's buying that share of stock. The person buying the share of stock is going to pay a slightly higher price than the mutual fund selling it. That difference is called a bid-ask spread. And what happens to that bid-ask spread is that actually that money goes back gets split between what's called a market maker broker-dealer firm that executed the trade, and also the broker representing the seller and the broker representing the buyer. That's called payment for order flow. That comes back to these brokers. Basically, the orders are going to a different broker to access the intermediary, often hold stock and inventory in order to facilitate trades. And then each of the brokerage firms representing the seller and buyer get part of that fee paid back to them. That is not reflected in the annual expense ratio. And there's also market impact costs. When you have funds and they buy and sell a big chunks of stock. If they're selling, they're going to force the price low. If they're buying, they're going to force the price high. And they can stretch out their trades over several days, several weeks even, and try to minimize that market impact cost. But basically, the bigger the fund is, the bigger the market impact cost is. Now, large company stocks, because there's so much market capitalization out there. You're talking, some companies that have $1 trillion or more of stock outstanding, or hundreds of billions of dollars of stock outstanding. The market impact can be not very great, but when you get down in mid cap and small cap stocks, those market impact costs can be really great. You also have an opportunity cost. Sometimes, pretty much almost all mutual funds will hold some type of cash because there are redemptions that have to be made. Some of the investors want to get out, or new cash comes into the fund, it's not deployed immediately. That cash is invested in money market funds, usually an affiliated money market fund, or just invested by the fund in treasury securities or something like that. And the result is that money that's earning interest, basically in a money market or a bond, in really short-term bonds, is only earning a small amount of interest, not earning the 8, 9, 10, or 11% expected return of that mutual fund. And the result is that the more cash you have in a fund, the bigger the drag on returns. All right, so let's review a summary prospectus. All right, now I'm going to pull one over here that I pulled up. It's actually one of the exchange traded funds that I indicated earlier. All right, and we'll skip down this first page. It's just a little thing here. And it shows that this is the Advantis U.S. Small Cap Value ETF, ticker symbol AVUF. It trades on the New York Stock Exchange. So you can actually go out and buy this. Now, when you buy an exchange traded fund, there is a bid-ask spread to there. You also can buy at a premium or a discount to the price. So it takes a little bit of education when you buy and sell exchange traded funds, especially if the trading volume is low. You might want to use what's called a limit order, but it's something that can be done. You can learn about it. So we'll kind of go down to the prospectus here and look. We got a table of contents here, and I'll just briefly go through there. First, it says the fees and expenses. This is a summary prospectus. It's only 17 pages. It says here's the management fee, 0.25%. Other expenses, 0. All right. Based on estimated amounts for the current fiscal year. So this is a relatively new fund. The fund complex may be absorbing those other expenses for the most part. Total annual expense ratio 0.25%. Exchange traded funds do not have 12B1 fees, so there's no 12B1 fee here. Then it says what's the cost of owning this over various time periods? Pretty low. This is a fairly low cost fund. Now, you'll see mutual funds that have 2 basis points or 3 basis points in terms of their fees. Those are usually in the large company, U.S. large cap stock space. When you're dealing with a specialized, this is a small cap value fund with profitability, you're going to see higher management fees associated with that. There's just more work involved. Now, we talked about portfolio turnover rate. All right. This fund is new. The portfolio's turnover rate is not available. Now, when the fund is really new and it's just buying, it's getting cash in and it's buying stocks all the time, in that first year the portfolio turnover rate, if it doesn't sell anything, is 50%, because you basically take you take the sales and the purchases, you add them together, you divide by 2, right? So portfolio turnover in a brand new fund can be really high. There's a lot of transaction costs that are being incurred there. Now, some funds and ETFs manage those transaction costs really well, especially on the buy side. Others don't do a very good job. My guess is this fund is going to do a fairly good job of managing those transaction costs through some techniques called patient trading and have flexibility in trading and the like. However, if I was personally buying this fund, I would likely wait for a few years. Usually, when a new mutual fund comes out, I say, "Hey, I like that." It, I rarely do this, but it might be a new fund that I might use as a tool in my toolbox for my clients. I'm probably going to wait 2 or 3 years, let other people invest the cash in that fund, and then the portfolio turnover will drop, and usually drop substantially. So I'm not paying a lot of those hidden transaction costs. Now, principal investment strategies: invest U.S. small caps companies. All right, that it has higher returns and high profitability or value companies. So one or the others. So we can choose one or the other. All right. And so it basically tilts towards value and it tilts towards profitability factor as well. All right. It defines value companies. All right. And it defines to identify small cap. Uh, they use financial statements and the like. All right. And they consider other factors. All right. And invest at least 80% in small cap companies, and that's just the threshold that most funds use. And the benchmark is the Russell 2000 Value Index, which I don't think is a very good benchmark. I'd like to see them benchmark against one of the other small cap value indexes out there. Um, and then it describes all the risk of the portfolio, the risk of investing in equities generally, the higher risk of investing in small cap stocks, and then um, there's a risk that it might be forced to sell sometimes and generate cash when it doesn't want to, and that might make the fund less tax efficient than they would like to. All right, and then we got market risk and some other risk here. Not all of that's reviewed. Here are the portfolio managers, and it's an exchange traded fund, so you can actually buy it through any brokerage firm, including pretty much any discount brokerage firm. Uh, and uh, and then it says we may pay the intermediary for Fells funds. This may create a conflict of interest. So some broker dealers might be incentivized to sell this fund. That is not good to see in my view, but at the same time, this has got a pretty low expense ratio for this type of fund. All right, and again, it describes the different risk and uh, who manage it, who's the investment advisor. Here, the investment advisor is American Century Investment Management. All right, so there's actually a company called that, and there are people who work for that company that manage the fund. All right, and here's the management team, and it describes them. Moved from dimensional funds. This person moved from dimensional funds. This person moved from dimensional funds. And this person moved from dimensional funds. So all four of the portfolio managers used to work for dimensional funds at one point. And then some other things here, nothing of significance, how the net asset value is figured, taxes, and things like that. And this also shows premium discount rate. Now this perspective is done only when you had 5 days worth of data. All right, so this was trading equal or above the net asset value 3 of those days. All right, I guess there were only 3 days there because the total days are three. So basically, when this fund was launched, people were willing to pay a small premium probably to buy into the fund relative to the net assets. You can have annual and semi-annual reports. There's a statement of additional information. There's a longer prospectus as well. All of that information is available to those who do due diligence on funds. But at the minimum, I'd recommend that whenever you do this, that you look and that you explore the summary prospectus of a fund. Look at those fees and costs. Look at those portfolio turnover rates and the like. And I Went all the way down. So let's see if I can get all the way back to the bottom. See if I had anything more. We'll do it this way. Yep. Oh, just one more thing that I had for you, and that's the end. Carpe diem. Again, keep keep track of the calendar, and we'll go from there. Thank you very much.